All right. How about lessons from a book I haven't read yet? So hopefully it's not terrible. Can you read it or is it backwards for you?
No, why does go up the stock market?
Oh yeah, that's probably how he wrote that. Exactly. That was the right way to interpret that. Okay. Okay, here we go.
And don't tell me it's because more people are buying than selling, because that's not true. Everybody buys and sells everything. You have to have
What?
a buyer and a seller.
Because earnings go up. That's why. Hold on. Let's see what this man has to say. Let's do
Steve says
one
that all the
snippet.
time, though.
Today's page of the day brought to you by Brian Feroldi's Why Does the Stock Market Go Up? Let's see. What is compounding? I know what that is.
Because
Do I
companies
need a financial advisor? What do you think, Brett?
do we need a financial advisor?
Yep.
Everybody needs a financial advisor.
No, it's so stupid.
What?
Of
Don't
course,
call me,
everyone doesn't need one.
don't call me stupid.
Come on. No, no, no. I didn't say you're stupid. I said that statement was stupid.
No, it's
Don't
not.
don't conflate the two things. I'm not talking at you. I'm talking about the thing that came out of your mouth.
Marcos, smart people don't say dumb things, okay?
Whoa. I guess neither do humble ones.
Sounds like another dig.
Welcome to Talk Your Chart, episode 36, recording on June 6, 2023. Happy birthday, Andres Segrera, my oldest nephew. Just graduated from Carnegie Mellon. Brett, I'm wasting no time, and I want to talk about the most important headline that I have seen in the last 5 days, which is NVIDIA and how freaking expensive it is. It's hilarious. So here's a chart I brought to you, Brett Horowitz. Can you see it there? We're looking
Yeah.
at NVIDIA's price to sales ratio. And the one that people are probably more familiar with, price to earnings ratios, where people are usually like, yeah, like a 40 or 50 price to earnings, right? Well, this is 204. Not that sets any frame, but
But
204,
even
Brett.
but even 40 and 50 is high, right? Like the S&P is typically in the teens, right?
Exactly.
And maybe they're a little higher. Maybe NASDAQ gets into the 20s or 30s. 40, 50s would be crazy. 200 is
Yeah,
ridiculous.
exactly.
And yet the
So check.
stock is up huge.
NVIDIA currently has $26 billion in sales versus a range of 200 to 500 billion for Microsoft, Apple, Google, and Amazon, right? Not that all together they're in there, like individually those companies have between either 200 billion or 500 billion. NVIDIA now trades at 36 sales over 200x earnings. What's going on here? This
So
is just
they're a chip maker, right? Is that that's what I understand. And
basically, right? The whole AI thing requires heavy computing that requires their super fancy chips. Don't ask me how they're made or work because I don't know how. So this is a tweet I'm reading for a gentleman by the name of Peter Maluk. The closest recent comparison is Tesla, which traded at nearly 30 times sales. Wait, 30 times sales, exact. So even worse. 30 times sales when it hit the $1 trillion mark back in 2021. What happened after that? It would go on to decline over 70% with its price to sales ratio falling to 5x.
yeah, you
Is that what
basically
happens to NVIDIA?
you have consumers, you have investors basically saying that they will be the one to win this game and that nothing can go wrong and that everything will go right. And if I'm an investor, I'm taking the short end of that side and saying, I don't see this happening.
I know. I mean, for me, I'm fine. I put 100% of my 401k in NVIDIA January 1st, so I'm good. This is actually my last day at Mesquite and Cats. Um, I guess here's the problem. I think what you get the big companies, if they don't eat a piece of NVIDIA's pie, then this is probably fine. It doesn't drop 70%. But when margins are this big, and for NVIDIA, the margins are real big, competitors come and say, I want a piece of that. And then NVIDIA just doesn't have a chance. It doesn't make the business bad. It just
Right.
makes a stock bad for a moment in time.
Well, we're thankful that NVIDIA is in all the big indices and that they're as big as they are. You and I talked about this before the show started, that I think May is when they really popped. I think when they had their big run. In May, the S&P 500 index was up 0.2%, so basically flat. The top 10 companies in the S&P climbed 9%, while the other 490 dropped 4.3%. So this is why you own the entire basket and not to try to pick a few companies here and there.
The haystack, not the needle, Mr. Horowitz.
Yeah, it's again diversification.
Yeah, last thing on NVIDIA. What's her name? The ARK funds and our friend Kathy Wood. Unfortunately, she's been the brunt of some some headlines as she sold NVIDIA in January. She did hold it in some of her funds, but the flagship ARK fund did not participate in the NVIDIA swing. Sorry, Kathy.
Kathy Wood is to me like the new Janus funds that we used to have back in the 90s, where it's all tech and it's up like 90% one year, then down 80% the next year.
I know. I don't mean to make her the brunt of all these things. She's an intelligent, awesome, bleeding edge person, but hasn't been great for Kathy in the not too distant past.
Well, the other big news that came out, that switching gears slightly, is the jobs report came out last Friday. And to me, it was shocking in a number of aspects. Number one, the number of new jobs was terrific. 339,000 jobs were added in the month of May, which is far more than what the average is or since the pandemic, and shows that we still have a strong jobs market. On the other end, you had an unemployment rate that ticked up, which was kind of surprising. And the third piece of news that came out was that the wages were down slightly, but not that much from previous month. So you take away from this, what? Good news, bad news, a little bit of everything?
Why did unemployment go up?
Yeah, I don't know. It didn't look like the wage participation rate, changed. So it was a surprising figure, unless people just retired.
So here it is. So according to the Bureau of Labor Statistics survey of establishments, employers added an impressive 339,000, like you said, in May. However, the survey of households suggested the number of people employed fell, causing the unemployment rate to rise to 3.7. So are we getting more quits or more layoffs that people aren't getting hired as quickly? I'm not sure.
You're not seeing it in the weekly unemployment data. That hasn't risen at all. You still have 10 million jobs out there that need to be filled, which has gone up a little bit from before, and 6 million people who are unemployed. So I'd be surprised if people are not working. As we said before, everyone's been quitting, has been finding a job right away.
Yeah, this has all been confusing enough, and now May just kind of adds to the conundrum. Companies are reporting job surge in May. Households say they plunged. Who do you believe? It doesn't matter, in my opinion. And I hate to say that, but don't worry. Next month we'll have the most important jobs report until the following month.
True, but I think for now, what it shows is not only the job market still strong, which every month that goes on, it's like another sigh of relief. Good, we're not seeing these huge job losses that we're all worried about. Consumer spending continues to go up, both on services and goods. So that's been a positive thing. GDP is still positive, as we've talked about. But there are some cracks forming, I think, in the system. And we talked about this before the episode started, but we want to talk today about GDI, which is
gross domestic income. Ding, 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 ding.
You got it. So what I read, and I'm not that familiar with GDI, so this is the first time I've really had.
No one is. So you better explain it perfectly.
So from what I understand, and I'll read from a news article I read.
Good choice.
GDI and GDP are typically about the same. GDI represents all of the income, wages, and profits that get accrued, whereas GDP are all the goods and services produced. So in effect, the people that are producing those goods and services get paid, and so in effect, they end up being somewhat similar. The problem, though, is that while GDP is up, even though it's not up that much, it's positive. GDI, the income figures, are down substantially, and that's partially because your weekly hourly work hours. No, I didn't say that right.
For payroll,
average weekly hours is down over the last few quarters. So your people are working less, but we're also getting less productivity. So people are not as productive in those hours. And those things are really, really negative because that's how you get the growth in the economy.
Yeah. So it's to add numbers to it. GDP rose at a 1.3% annualized rate Q1 of this year, while GDI, to your point, fell 2.3% annualized, the second consecutive quarterly decline. So this is all you just saying, you're right, Marcos, the recession is going to start in Q4?
I don't know about that. It says there's some odd things happening. Normally, what they say is that when you have a recession upcoming, you have firms that lay off people. In this case, there's probably a lot of job hoarding out there, which is people do not want to get rid of the employees that they hired. And a lot of companies still don't have enough employees to make things work, which is things we talk about lots and lots over the last few years, like who's going to lay off somebody, even if you have a recession, because you got to keep what you have. But if you have less productivity, people are working less hours, less income being produced, like that's all a big negative to how the economy is going to grow. Like you need all those things to be positive, not negative.
Yeah, I'm gonna keep. I'm not gonna say what I was about to say because I was gonna push us towards earnings, but I think the GDI piece, and again, if you look at it historically, it kind of just says we're slowing down. What's going to cause a recession? I don't know if you've gotten in the calls or the comments. I've gotten a few calls and emails from clients when we talk about recession as it comes to employment and earnings and all this type of stuff. People saying, wait, should we be worried if the recession's coming in Q4 of this year? The answer there is markets and economy, while related, are different. We got the pain in the markets last year. The economic stuff comes later, especially because those numbers are always backdated. So how do you put this all together as it comes to employment and what you do, how you look at it, how you respond or don't?
Well, I think this is why the Fed is having such a difficult time trying to figure out what do we do with interest rates. They're probably going to pause in June is the expectation, but then you see these big job numbers and you say, well, I don't blame them if they keep rising. Then you see negative GDI, but then you see, positives.
Wages are down though. You said wages are down, right?
Wages are coming down, but not that fast. Like they're still above 4. I think the last number was 4.3.
Yeah. The next inflation print is going to be a bigger indicator, I think, of what the Fed's path is over the employment and wage stuff, because it's not as hot as it was. So they need something more concrete.
But bottom line, I mean, don't you think that you can't just look at a playbook from last time we had a recession and say like, this is following the same book. Like there's lots of things that are very unusual about what's happening out there that nobody can really explain right now.
Yeah, I agree. And that's why I think pausing is better. When it's unclear, kind of, or you're lost, so to speak, like staying where you are is generally the better course. I just still think that the market bottomed in October of last year. Get the bearest strategist on Wall Street. And this guy always is, Mr. Wilson over at Morgan Stanley, Michael Wilson, Chief U.S. Equity Strategist at Morgan Stanley. He has a year-end S&P target of 3,900. What's the S&P at right now, Mr. Horowitz? Do you know?
42 something.
So 3,900 is less than that, like 10% less or so. So if you drop to Mike Wilson's most bear strategist on the street at 3,900, guess what? You still don't get to the lows from October 12th of last year, right? And he's calling this a nice cyclical bear with a secular bull right after it. Because what happens after we get our earnings recession, which I agree really doesn't look like it's happened yet. Companies are still beating like they usually do. If we get the earnings recession, okay, fine, I'll give you 10% downside in markets, and then I'll give you, here comes the next secular bull. You're welcome.
What about the fact that the S&P is within spitting distance of hitting a new bull market? Would that not would that say to you, hey, let's get on this ride now, we're back in a bull market, and that we're not going to see this decline?
That's fine. The bull can start and still drop 10%. And I don't think it's unreasonable to say that we've gotten ahead of our skis like through June of this year with the absence of breadth in the market, and breadth with a D, meaning of all the constituents in the S&P 500 who's contributing to the gains. It is more concentrated than usual, right? Like, yes, we're happy with it. Concentration is normal, but it doesn't show a lot of kind of secular or broad-based strength in the market. So it wouldn't be shocking to me to start the new bull. We celebrate that, so to speak. I think you said it's going to be the end to the second longest bear since 1948.
No, the longest end to the longest bear market since 1948.
It'll be the longest, and it'll be number one.
Right.
All right, history being made, man. What a time to be alive. What a time to be alive.
Well, the other worrisome thing that's out there is the banking system being in turmoil, and there's talk about some new capital requirements being put in place where banks will have to hold more in reserves and not loan out money.
Yeah,
I've got a chart here showing that if you're a bank, especially the big banks who don't have an online presence only, you're getting creamed with people pulling out their deposits. And I guess that's kind of expected, right? Because we've been saying for years, unless you don't know what's going on or you're too lazy, like take your money out of the big banks, go to an online bank, go to a company that's going to pay you some yield. That's where all the money's going right now.
I know. Look at those banks at the right side of that chart. Truist, US Bank, Citizens, Western Alliance, PacWest. Who don't you see on there?
I don't see a lot of banks. I don't know what's.
I know, but or I guess better, what's common amongst all those banks?
Well, the other part is all of them with positives have an online presence only, right?
No,
That's
I
where
get it. I know, because they give you the savings rate. What I'm saying is poor regional banks, man, they're getting cooked, and we're getting extra concentration in the banking system. I don't know if that's good or bad, but people are basically saying having money at JP Morgan's like having it at the government. I don't know if that bodes well moving forward, but we'll see what the regulations look like. To your point, though, if we get more stringent capital requirements at banks, that does the Fed's job for it. That is going to be contraction. You already see disinflation in the inflation prints. So I think inflation peaked. Move on.
Well, but I would say though that I would not, if I were a regional bank, I'm pretty nervous about these trends. There was the article,
Absolutely.
an article saying that it costs roughly $500,000 to run a bank in a small market and about 1.3 million to run a bank in a large market. And the banks are going to tell you, well, traditionalists like to go into the bank to get a mortgage, to talk to somebody. I don't know about you, but I have not been to a bank in decades. And to even get a mortgage, I don't need to go into a bank to get a mortgage.
Don't know what the inside of a bank looks like. I just have like a bank robbery scene from like the 1920s in my head.
Okay.
I'm thinking, oh man, it's such a good film with Tom Hanks. Come on, you know this one.
And
Road to Perdition.
Don't know that one.
Jude Law, Tom Hanks. It's an absolute wonderful film. Go watch it.
Okay, I'll put it on my list. Last chart I've got here is growth versus value. We talked about this in the past, but I think it's interesting in that, over the last couple years, growth has just crushed value. For the 10, 15 years before that, value crushed growth. One of the interesting things that I read was that since 1984, the performance of these two, growth and value, the S&P 500 growth, S&P 500 value, is almost roughly the same. And so I don't think somebody should look at this and say, well, let me try to pick which one's going to do best going forward. I think you have to have both in the portfolio at all times, because you don't know which is going to do better. And they've had some radical dispersion between them over the years.
So
which is what we do in our portfolio.
You still support an overweight to value?
Yeah, overweight to value, but not at the exclusion of growth.
Oh, right? No, impossible. Impossible. How about the whole idea of a lot of those tech companies became value companies? There's the conflation. People get confused. They think growth. The problem is growth just means you have lower expected returns. That's how the math works. If you don't be too smart about it. And I'm not, so trust me, that's what I'm doing. Value, look at Facebook. Boom. Facebook suddenly was a value company. Apple was suddenly a value company.
Look at Warren Buffett. Case closed. Value.
Oh, God, Warren Buffett.
He's value, right? He's not going to pay a high multiple for some company. And so he says,
just
wait till it
invests
drops.
In what he knows in. Warren gets accused of too many things, good and or bad. Let's talk about Charlie. I like Charlie better.
100-year-old Charlie.
All right.
Hopefully you and I are living till we're 98 and 100 and still running things on Talk Your Chart.
I know. I'm going to go grab a Coke right now. Get you one?
McDonald's. I'll take some McDonald's.
All right. Horowitz.
Till next time.
See you.